In this week's video, we'll review the 25 charts of Christmas to see what we can learn about the market's risk-reward profile. We'll be moving quickly, so feel free to use the pause button on your video player. Let's start by reviewing the state of the October rally attempt. The chart on your screen is dated December 20th, and it was tweeted on December 21st, right after the market opened. This is the June high in the S&P 500 here. This is the October low. The colored lines on the screen show exactly what the name implies, the volume-weighted average price. Thus, the purple line down here, anchored to the October low, tells us at this point right here, the average market participant, based on volume, was underwater at this point here relative to their cost basis. And that was true as of the close on December 20th as well. If we fast forward to the close on Friday, December 23rd, when the S&P 500 was up 22 points and closed at 3844 and change, the same is true. For the average market participant that bought at the low here in October, they're underwater as of the close on December 23rd. As you can see, that's true if you bought at this high here in June, at the low here in June, if you bought at this high here in August, if you bought at the low in October, and if you bought at this high here, denoted by the red line. So how is this helpful? This band right here is an area of possible and strong resistance as long as price remains below it. It's probably fair to say the rally is in jeopardy the longer we stay below this band. And the rally attempt gets quite a bit healthier, especially from a psychological perspective for market participants, if we can get to the other side of the band. These levels change each day. This level here is 39.31 as of the close on the 23rd. The lower end of the band comes in somewhere around 38.70-ish. If we go back to the chart dated December 20th, you can see when the market rallied up into the band, on this first pass here, the band acted as resistance. Thus, in its present form, the stock market bulls need something to change on this chart, and that may happen very, very soon, as early as Tuesday of next week, but it hasn't happened yet. Now let's see what we can learn from one of the latest reads on the U.S. economy in the context of current Fed policy. There's a lot going on here on the screen, but it's easy to understand if we walk through it slowly. Orange line is the year-over-year change in the leading economic index, which tracks 10 leading economic indicators. And as described in the tweet here, typically when the economy gets as weak as it is in the present day, the Fed is already responding up here, this is the federal funds rate, by either pausing or lowering interest rates. And that would be the cases with the yellow lines, where the economy is weak and the Fed is responding in a stimulative manner. Not the case in the present day, hence the red line. The economy is weak and the Fed has been raising interest rates. The last time something similar happened was here back in the 1970s. So this point here, near the zero line, is very, very similar to this point here. And this version of the LEI shows us the recession here. The shaded area is an economic recession, and it also shows the S&P 500 in red on the bottom of the chart. So the point of this tweet, the present day here, we can make an argument, is similar to this point here back in the 1970s, and that's basically the same point as this point here. You can see this comes in here very, very close to the shading where the recession starts. And we know historically that this recession started in November of 1973. Thus, it might be helpful to ask and answer. How did the stock market look in November of 1973, and how does that compare to the present day? If the economic recession began in November of 1973, what we really want to know is, what did the stock market look like just prior to the recession? So the end of October 1973. That's this point here. This is the stock market here. And we've covered these weekly cloud charts in the past. This is not a good setup on the weekly cloud. If you look at this box here, we can check for the most part all of the bearish boxes. And we just said the present day here from an economic perspective is similar to that point. which for the most part is represented here by point A. After that, on the chart, with this weak-looking profile on the weekly stock market cloud, the S&P 500 lost an additional roughly 43%, let's call it. So we already know from an economic and Fed policy perspective, there are some similarities between this point, and this is what the stock market profile looked like at that same point. Now, let's compare November of 1973, when the recession started, to the present day using the same weekly cloud. The chart on the left is November 9th, 1973. And just from a pattern recognition standpoint, pretty easy to make the argument that the chart on November 9th, 1973 does look similar to the profile during the trading session on Friday, December 23rd. In both cases, the green span is below price. In both cases, price, right here, is below the cloud. In both cases, the cloud has already shifted from green to red, and in both cases, price is below red. This is the present day here, this is price, this is the red cloud line here, price and the red cloud line on November 9th, 1973. Only in one case can we check this box, the present day. During Friday's trading session, blue was still below red. Not the case here, it had popped back above. So we couldn't check all of the bearish boxes here, and yet the outcome walking forward from basically the same point was not desirable. How about if we compare the 2008 bear market to the present day? We've covered this chart many times. If you pause your video player, it's pretty reasonable to make the argument that the moving averages, the white space between the moving averages, where price is relative to the moving averages, and the order of the moving averages, green, red, blue, is somewhat similar to this point here in 2008, and somewhat similar to this point in here in calendar year 2001. This is an S&P 500 weekly chart going back to 1999 with the 30, 40, and 50-week moving averages. So how about the weekly cloud chart? If we zero in on the 2008 case in this general area here in 2008, it's probably fair to say that the S&P 500 chart looked worse in the 2008 case. We look a little stronger in the present day, but as we just covered in the previous segment, we don't look very good. We're still checking a lot of bearish boxes on the weekly cloud on December 23rd. And on September 5th, 2008, we are basically checking the same boxes that we can check in the present day. And this is September of 2008 in here. Even if we just look at price here, this setup is similar to the present day, but the present day looks quite a bit stronger. You can see here on this attempt, we couldn't even get back to the moving averages. Here we did. Similar, but a little worse over here. What about fundamental data? You can pause your video player here. This is a Morgan Stanley piece. What it says is there are a lot of similarities in terms of the data on your screen when we compare August of 2008 to the present day. Here's August of 2008 right here, similar setup. And here's August of 2008 in here, somewhat similar to the profile in the present day. And as we've covered in past videos, one of the major concerns in the present day is the monthly momentum is incredibly weak. You can see momentum in the present day looks quite a bit different than anything that we've seen. We have to go all the way back to the second half of 2008, somewhere in the July-September timeframe, to get a monthly Kopik curve that's as low as what we're seeing on December 23rd of 2022. So the last time we were this low, July, September-ish 2008, and prior to that, it's calendar year 2001. We almost hit it here. We did hit it here. Prior to that, you have to go back to the 1973-74 bear market. This is where we were here at a similar point. This is what the stock market did. Doesn't predict what's going to happen next. It's just telling us this is rare and very, very weak monthly momentum. And it's also rare to see a trend this week. What about the latest holiday message from the bond market? As shown on the tweet left side of your screen, here's the source of the tweet down here. 91% of the yield curve is inverted. That's extremely rare. And you can see historically, going back to 1970, Typically, when you get above this line here, typically see a recession, and typically good things do not happen in the stock market. And as Dean points out, it's not just in the United States, this is globally. So what does this tell us? Well, we know from past videos, this tells us historically something similar has happened. Typically, a recession has followed, and that speaks to very elevated recession probabilities in the present day. Thus, we have to ask and answer, is it reasonable, given the evidence that we have in hand, that earnings for the S&P 500 next year are somehow going to be basically the same as they were in calendar year 2022? Or are they going to drop just a little bit or even rise? How reasonable is that? So, very high probability of a recession coming sometime in the next 12 months. And we know from past videos that there's a very strong correlation between economic recessions and pretty significant declines in earnings per share. If we look at all of the recessions going back to 1957, even if we take out the dot-com bust bear market and the financial crisis, the average decline in earnings, almost 19%. So if we take earnings for this calendar year and we reduce them by this number here, 18.7%, that gives you $179 in earnings next year, hypothetically. At a multiple of 18, that's $3,200 on the S&P 500. At a multiple of 16, hypothetically, that takes you under $2,900. As always, we're talking about probabilities here, quite a bit different from certainties. And we also know, if we see something similar to what's happened in the past relative to an earnings recession, then it's reasonable to think the S&P 500 could trade between 2,800 and 3,200. As we've covered in past videos, that aligns with what typically happens during a bear market. Typically, if you use this as the peak, early January 2022, typically you would fall somewhere between 3,500 and let's call it 2,700 and change. And a typical bear market would end maybe late January of next year. If you go into a recession, typically here in terms of the calendar, you could spill over into early Q2, at least relative to history. This says we have a high probability of a recession. This data from this week says we have a high probability of entering a recession. If we look at all bear markets, even bear markets where the economy avoided a recession, the typical drawdown in the S&P 500 is somewhere in the neighborhood of 3,200. In the recessionary cases, quite a bit worse. The median drawdown in the recessionary cases, almost 40%. The average drawdown, 42%. The duration, approximately 16 months. If we saw something similar relative to the peak in early January of this year, hypothetically, the S&P 500 would bottom somewhere in the neighborhood of 2782 to 2926. Remember this 2782 number. That looks pretty similar to this number here. On December 23rd, the S&P 500 closed at 3844. So if we zoom in and focus just on the cases that featured economic recessions, and we fall somewhere hypothetically before this is over between 2782 and 2926, let's call it 2850. 2850 hypothetically on the S&P 500 is approximately a 26% drop from the close on Friday, December 23rd. It's not a forecast in any shape, form, or fashion, but it seems to align with history, and it seems to align with what typically happens during recessions in terms of what should be a reduction in earnings per share for the S&P 500 next year. Now, if a drop of that magnitude seems unrealistic, even if we just went down to the lower portion of this trend channel hypothetically, and even if we dropped straight down, that would take us approximately to 3,300. There's a lot of white space here that could be filled. And we also have unfilled gaps back here in the same general vicinity. And if it takes longer, hypothetically, time-wise, for price to get down to these lines, then we could easily see price falling below 3,300. Not a forecast in any shape, form, or fashion. But the look of this chart here really doesn't do anything to discount these numbers up here. And clients and regular viewers may remember, this year we were down 10% or greater in August. Typically, when something like that has happened historically, the additional drawdown in the S&P 500 take you somewhere in the neighborhood of 3,200-ish, quite a bit lower than where we closed on Friday, December 23rd. We pretty much know with 100% certainty if the October low was the low and a new bull market has started, then the trends on multiple time frames have to flip from downtrends to uptrends. And common sense tells us, and history tells us, we should also be able to spot significant shifts in the risk appetite of market participants. Do we have that in the present day? Covered this numerous times. This is the S&P 500's 30-week moving average. This is after the major low in 2002, 2003. This is after the major low in 2009. I might add, several months after the low. Several months after the low. We're several months after the low now. Trying to figure out, does this look like a major low? Does this point up here look like this area in here? Or does it look like this area in here? It's pretty easy to say. Not yet. And notice the slope of the 30-week moving average. The slope. This is the slope. We've removed price so we can focus on the slope of this line. This is the slope of the 30-week moving average on December 23rd at 12:24 p.m. Eastern Time. It may turn up soon. It hasn't turned up yet. You can find these charts and review them in our Twitter feed. Here's the Twitter handle. This is I'm more confident about the economy and earnings XLY discretionary divided by I'm concerned about earnings and the economy defensive XLP. There was a bullish divergence months before the S&P 500 bottomed in March of 2009. We don't have anything like that in the present day. If this was a major low in October, look what the ratio has done since then. Here's a low. Here's a lower low. Here's a new year-to-date low being made on Thursday of this week. Here, when the S&P 500 bottoms, you can see the moving averages are starting to turn up. We're starting to see some good things happen. This is what increasing risk appetite looks like. Right now, on Thursday, December 22nd, we've got a full-bore bearish look with blue, the fastest moving average on the bottom, price below all of the moving averages, and the slopes of all of the moving averages are down. That's quite a bit different relative to this morphing and improving look in here. This may change very, very soon, but it hasn't changed yet. This type of analysis here helps us in two ways. Number one, what does the present day look like? Not very good relative to history. And maybe more importantly, what should we be looking for when the odds of good things happening start to improve? And as we all know, improvement could start on Tuesday morning after the day off on Monday. Very, very similar situation here. If new long-term uptrends are going to emerge, the slope of the 8-month moving average and the 9-month moving average here, they can't look like this. They have to start to improve and morph into something like this in calendar year 2009 and something like this in calendar year 2003. And once again, that may happen very, very soon, but during the session on December 23rd, blue is making a new low for the year, and so is red. And the S&P down approximately 6% month to date, and that was intraday on the 23rd. It's pretty easy to make the argument that this tepid look in here, or this tepid look in here, is somewhat similar to these tepid looks in here and this tepid look in here. It really doesn't look anything like this improving risk appetite look here and this improving risk appetite look here. And I might add, this look is improving several months after a low. The stock market bottomed 71 calendar days ago. So if this was a major low, shouldn't we be seeing something like this after the low? Or something like this? The answer is yes, we should be. And it may happen very, very soon. We just don't have it in front of us today. And instead of the trends looking like a new bull market, they look a lot like this point here in 2001 and this point here in 2008. This is roughly February of 2001. Right here, this is July of 2008. This is the monthly cloud. Blue and red is what you're focusing on. Blue is dropping below red. Blue is below red. Blue in the present day, December 23rd at 2 p.m. Eastern Time, blue is below red. From here and here, the additional drawdowns, 37% and 46%. The number of calendar days till the low, 588 from this point here, 221 from this point here. We're not saying this is going to happen or this is going to happen or even this or this, but this isn't a good setup. That's really what we're saying. This needs to improve. Similar situation in 1973. Blue drops below red here in 1973. The bear market doesn't end until 1974 out here. If you've invested for any length of time, you've run across the expression, the generals are the last to fall. These are all going to be weekly cloud charts. It's very, very easy. Go to the bullish checklist and the bearish checklist, and you will find that this Google chart on December 23rd, it doesn't look good. Apple looks better than the other ones we're going to show, but it's very, very vulnerable here. Is green below price? Yes, it is. Is price below the cloud? Yes, it is. Has the cloud flipped from green to red? Yes, it has. Price below red? Yes. Blue below red? Yes. Can check it, we can check it, we can check it, we can check it, we can check it. This one looks worse. Why is this relevant? These are extremely large capitalization stocks. It's very difficult for the stock market and S&P 500 and the NASDAQ to perform well, or major growth-oriented mutual funds or ETFs, when Amazon, Apple, and Google look this vulnerable. Same thing can be said for Tesla. Forget about the cloud. Just look at trends. These are moving averages. This looks like a massive topping pattern in here. From this point A to this point B, price is below the 38.2, 50%, and 61.8% retracements. And we have a full bore bearish look with blue, the fastest moving average on the bottom. The slopes of all of the moving averages are down, and price is below all of the moving averages. Contrast that to the full bore bullish look morphing in here. We're morphing from a bearish to a bullish look, and this is 2019 here. This is 2020. If October of 2022 is or was a major low, or turns out to be a major low, we would think that we could answer these questions in an affirmative manner. Have interest rates peaked? Is the market acting in a way that looks like the worst relative to inflation is behind us? Does it appear the Fed is shifting from our enemy to our friend? Are the credit markets signaling the worst is behind us? If the worst was behind us and interest rates had peaked, it would make sense to lock in higher yielding instruments, to buy TLT while the yield was high, and stop buying ultra short instruments as protection. The weekly trend in the ultra short instrument relative to TLT is still clearly up, and we're back above red. Defensive SP low volatility divided by the S&P 500 or SPY, been consolidating for 10 months. The longer the breakout holds, the more relevant it becomes. The ratio is above an upward sloping 200-day moving average. Momentum favorable for SP low volatility. Really, everything we said about the last chart applies to this chart. Pretty easy to see XLP divided by SPY is in an uptrend, 200-day, 50-day price. Pretty easy to see it's in an uptrend here, looking at the weekly cloud, weekly breaking out to a new high. Look at the chart and see how many of these bearish boxes we can check and how many of these bullish boxes we can check on December 23rd at 2:35 p.m. Eastern Time. This allows you to compare the weekly cloud to the dot-com bust bear market, the financial crisis bear market, and the 1973-74 bear market with high inflation. You can also find this chart on our Twitter feed. Here's the Twitter handle here. This version dated December 16th. This one dated December 22nd. How is this helpful? Read this little blurb in here. What does this data look like after a major low, and how does it compare to the look of the data in the present day? Does the data today look more like after a low or during a bear market? So here's the low here in October of 2002. After the major low, you can see that breadth indicator doesn't spend a lot of time in the orange box, and it spends a lot of time in the green box. Major low here in March of 2009. After the major low, the breadth indicator does not spend much time in the orange box, and it starts to fill the green box. Well, the S&P 500, if October was a major low, made a major low 71 calendar days ago. Well, this is the chart on December 22nd. This may improve, but we just don't have a look right now that says this looks like a major low. So like the other charts, this is helpful relative to what does the risk-reward ratio look like right now. It's also helpful. What should we look for to become more constructive on a major low being in place? Flexible, unbiased, and open mind. We just don't have it yet. In fact, the indicator is way down here on December 22nd. It's probably fair to say this look in here looks the most like this look in here in 2007 and 2008. And if the worst was behind us, we would expect that interest rates would have flipped from an uptrend to a downtrend. That may happen soon. It hasn't happened yet. This is the 10-year yield. You can see it's still making a series of higher highs and higher lows. Higher high. So far, this is a much higher low relative to the low that was made earlier this year. The weekly cloud, you can check a lot of the bullish boxes here. We're making a stand. Red right here, we closed above red. Blue is above red. Green is above price. Price is above a green cloud. And similar to making a stand here earlier this year at red, where momentum oversold started to turn up, looks like momentum on this weekly chart is trying to turn up a little bit. We're still in an uptrend. It's possible, not a forecast, the 10-year yield next year could go to 5.25. And this doesn't look that great yet, but if we go to the daily version, you can see momentum has improved significantly in recent sessions. We could draw a trend line from this point to this point to this point to this point. We're clearly still in an uptrend. That may change, just hasn't changed yet. As always, 100% of the commentary in this week's video is based on the charts, data sets, and facts that we have in hand. If the facts change, then we have to be willing to reassess those odds. It's extremely important that we don't get stuck on any story. A bearish story, a bullish story, a Fed story, an earnings story, a technical story. We have a rare combination of circumstances here, including high inflation, telling us any historical analysis needs to be taken with a grain of salt. We're all dealing with a situation that for the most part none of us have dealt with during our careers. Thus, it's incredibly important you make no assumptions about any topic on any time frame. As we said earlier, if the S&P can get out here, then a lot of things can change very, very quickly, and we are open to that. We'll see how it unfolds. I want to sincerely thank all of our clients for hanging in with us during a difficult year. We also appreciate our regular followers, viewers, and listeners. And we all know if the market's risk appetite improves, the only way we're going to be able to see that properly and acknowledge it and react to it is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.